Hello, Michel.
Hello.
We are at the end of June. It's a perfect time to look back at the first 6 months of this year. So globally, how did the markets do?
Well, everything is fine, but there are two striking elements. The first one is if you put aside copper prices and the Japanese stock market, all asset classes have gone up. And the second element is, in some cases, you have made more money in corporate bonds than in equities, and that's rather unusual.
So how is that possible?
Because we're in a very specific environment. Central banks are still pushing down interest rates and bringing liquidity and pushing investors to buy these high-yield corporate bonds. And the second element is, in the same time, we're seeing a recovery, economic recovery in the US and Europe, and in that cases, normally corporate profits are rising, and that is good for the stock market.
But we hear some voices who say that central bank policies are creating a financial bubble. What is your opinion?
But it is true that these monetary policies have been created to stimulate economic revival. But in the same time, these policies have created a sort of sense of permanent low interest rates for the investors. And that is the reason why they're running to find new investments with a higher risk, but without having a big interest rates or big yield.
So investors are focusing more on bonds?
Oh, definitely, and we're seeing their speculation. And we are at least three signals. The first one is these corporations in the USA, which have a low quality balance sheet, are borrowing really a lot of money. They've borrowed more money than in 2007. Second element is when you look at the spread, the surplus of yield that you can get on these high-yield corporate bonds, this surplus of yield compared to the US Treasury is almost nothing today, and that has never happened before. And the third element is in Europe. Spain today is able to borrow money at 2 years maturity at a cheaper interest rate than the US. So that's the proof that there is too much money and people are running for getting anything without thinking too much about the risk.
So what is the risk?
Well, the risks are numerous. The first one is for the borrowers. If the cycle turns, they will have some difficulties to pay back the money to investors. And the risk for investors is to suffer losses on their investments, or maybe to not be able to get back the money.
So this is what we call a liquidity risk?
It is the liquidity risk. And what is worrying is that the central bank in the USA and one of the biggest fund managers in the world, BlackRock, are thinking to impose what we call an exit tax when people want to redeem their investments in mutual funds investing in these higher yield bonds. And that is worrying because that shows that there is a problem, and probably people will start to redeem before we're seeing this tax, and that might create a sort of panic at one moment and pushing the people out of these investments.
So what do you recommend?
Easy. You have to reduce your investments in these high yield bonds today. If you want to keep that, no problem, but have them with a very short maturity in order to get back the money in 1 year or 2 years maximum. Otherwise, you have to move your investments into equities, another asset class, where equities are cheaper than these high-yield bonds. And among equities, you have to select corporations which are able to generate high cash flow, durable cash flow, and able to give dividends and high dividend yields.
Thank you very much, Michel.
Thank you.